It's very easy for us to go out some evening and have dinner and spend 4,000 or 5,000 rupees. We are also very comfortable in buying completely unnecessary and useless stuff on Amazon. But if you're facing a loss of even 100 rupees on a stock, and even if we know that the stock is going down, we continue to hold on to that stock in the hopes that we will make a profit tomorrow. We do not book losses. We do not get out of the trade. If you've done that, don't worry. It's a very common psychology among share investments. I have been guilty of that too. Hello, folks. My name is Neil, and in this channel, we talk about demystifying the art of making money on the stock market. And today, we will talk about stop loss. So, why should we book a loss? After all, we are in the business of share trading to make a profit. Well, I can give you three reasons off the top of my head. Reason number one, if you would have booked a small loss and gotten out of it, you would have the liquidity to invest in another stock. The same money would have been invested in a profit-making stock and you would be making money. And it's very easy to recover that small loss. Reason number two, the more time you spend in a loss-making stock, the more the loss keeps on increasing and the more difficult it gets for you to get out. The more difficult it gets for you to recover that loss. And reason number three, the cost of time. After all, with the passage of time, you should be making money, not losing money. So every minute that you spend not making a profit is an opportunity lost for you. So, but then how do you book a stop loss? How do you know whether you should stay in a trade or get out? Because after all, the share price keeps on going up and down, and it is not guaranteed that the share will never go below the price that you've bought. Well, you give it a comfortable range. I usually give it a 1% to 1.5%. And it's very simple. If you've made a loss of 1.5%, get out. But it's a little bit tricky. How do you know at what price to buy? Now, I've got two more videos in which I'm talking about one, eyeballing a chart and understanding when to buy at the lower end of the curve. And second is I've talked about an indicator called the relative strength index. And I will share the links to those videos in the description. Today we will take a look at one more indicator called the Bollinger Bands. And all these indicators, once we've understood, we can use them in combination to identify the right price to buy and sell. So what you see in this chart is the chart of Deepak Nitrate. Let's add a study. The indicators are also called study, and most demat accounts and brokers allow you to add studies to your candlestick chart. I'm going to add the study called the Bollinger Band here. Now, Bollinger Band is a indicator that shows you how a price whiplashes after a particular point in time. And every time it hits the upper Bollinger Band here, for example, it whiplashes down. See, here it touched the Bollinger Band, went down. It touched the Bollinger Band, went down. Touched the Bollinger Band, went down. And every time it hits the lower Bollinger Band, it goes up. Touches it here, goes up. Touches here, goes up. And so on and so forth. And you can, this is the daily chart, you can take a look at any chart, like for example, the 60-minute chart, if you are trading in the shorter time frame. It touches the Bollinger Band, goes up, touches it, goes up, and so on and so forth. But there are always exceptions to the rule. This is a very high probability indicator of whether the price is going to go up or down, but it's not 100% guaranteed. Like for example, if you look at this area, it did touch the Bollinger Band, but it continued to fall. It did touch the upper Bollinger Band, but it continued to go up. So it's not guaranteed. There is a high probability that it will whiplash, but it's not guaranteed. And that's why we don't rely on one indicator only. We use multiple indicators to understand what is a good price to buy. And we never buy without a stop loss. So let's say that our indicator did not, the price did not respect the indicator and it continued to fall, like in this scenario, right? We get out. So for example, let's say that I had an entry at this point, 1652. Considering that it has touched the Bollinger Band, I'm expecting the price to whiplash, upwards. But let's say that it did not whiplash, okay? It continued to fall. Now 1652, 1% is about 16 rupees. So I would, let's see, could I use the calculator here? 1652 minus 1% gives me 1635. Let's say I keep a um, stop loss at around 1635 or probably slightly lower, 1634. Okay, and the moment it hits 1634, I book loss. I sell the, sell the in intraday. It allows you to set the stop loss automatically. So if it hits the stop loss, it will automatically execute the trade and book losses for you. In this particular case, I do it manually because I don't do intraday. I sell the stock off with a loss and I get out. Now, what that means is I have my liquidity back. I'm not invested in the stock. Later on, what I do is the next time it hits the Bollinger Band, let's say it hits the Bollinger Band here, right? I don't know. Okay, just a second, let me get it. Right, this is where it hits the Bollinger Band. I set a stop loss, 10% below roughly here, and then uh, I um, I set the trade, I buy, right? And I can easily get out somewhere around here. And we will talk about what would be the best time to sell in a different video. But let's say that I get out here, I recover my losses, I book my profits, and everyone is none the wiser. So um, today, what we need to understand here is it's okay to book losses as long as we are making more profits than we are making losses. And I usually follow the rule of 1:5. I'm okay to book a loss of 1 rupees as long as I have the potential to make a profit of 5 rupees. I hope you have enjoyed the session today. I'm always looking forward for feedback. Oh, the stock tip of the day. Let's talk about the stock tip of the day. Um, just a second. The stock we are going to talk about today is Concord. Um, on the 60-minute chart, you can see that Concord has already touched the Bollinger Band. It's a good, I mean, it's okay to buy the stock even at the current price, but I would go further and buy it probably at this level, about 560 and 560.70. That would be a fantastic price to get Bollinger Band. If you look at the relative strength index, which I've talked about in one of the previous videos, just a second, let me add the study. The relative strength index is very low. I mean, it's quite low at this point in time. It's at 37.24 already. Anything below 40 is a good time to buy. But by the time it reaches 560.70, it'll be around 28, 25 or so, which would be a fantastic price to buy. I would use a staggered approach, buy some stocks, and then if it continues to fall, either uh, book my loss at some point here. Sorry, 553 perhaps, or slightly low, above or lower. I would count about 1.5%, 2% and book loss there, and I would keep a target of 626. It's giving me an 8:1 rewards to risk ratio, which is a fantastic rewards to risk ratio. I hope you have enjoyed the content today. Always looking for feedback. If you disagree with my ideas or have other other ideas that you would want me to discuss, do voice out, and it would be fun. Um, I wish us all the best of luck, and I hope that we make a ton of money out of the stock markets. Have fun.